IRRBB, Interest Rate Risk in the Banking Book, exploring the significance and measurement of IRRBB. Agenda: Introduction to IRRBB, Sources of Interest Rate Risk, Measurement and Management of IRRBB, Impact on Financial Stability. Definition and significance of IRRBB. IRRBB stands for Interest Rate Risk in the Banking Book, signifying potential losses due to interest rate changes. Impact on financial health. IRRBB significantly affects a bank's net interest income and overall economic value, influencing its financial stability. Risk management strategies. Effective risk management strategies are crucial for maintaining a bank's profitability and mitigating financial risks associated with interest rates. Difference between banking book and trading book. Banking book overview. The banking book contains assets and liabilities held for the long term, focusing on stability and income generation. Trading book overview. The trading book consists of financial instruments held for short term trading, aiming for quick profits and high liquidity. Risk management importance. Understanding the differences between the banking and trading books is crucial for effective risk management and regulatory compliance. Regulatory framework and guidelines. Guidelines for IRRBB management. Regulatory bodies have established guidelines to manage interest rate risk in the banking book, ensuring banks maintain capital adequacy. Capital and liquidity requirements. These regulations ensure that banks have adequate capital and liquidity to operate safely in financial markets and manage risks. Importance of compliance. Awareness of these regulations is essential for compliance, helping banks manage risks effectively and maintain stability. Sources of interest rate risk. Repricing risk. Definition of repricing risk. Repricing risk occurs due to timing mismatches between assets and liability repricing, affecting financial institutions. Impact of interest rate changes. Fluctuations in interest rates can significantly affect net interest income, leading to financial volatility. Asset and liability management. Effective management of assets and liabilities is critical to mitigate repricing risk and stabilize income. Basis risk. Definition of basis risk. Basis risk refers to the risk of mismatch between interest rates on correlated assets and liabilities. Impact of yield curve shifts. Shifts in the yield curve can cause unexpected changes in income due to basis risk, impacting financial planning. Asset and liability mismatch. A mismatch between interest rates on assets and liabilities can lead to increased exposure to basis risk. Yield curve risk. Understanding yield curve risk. Yield curve risk involves the potential changes in the shape and slope of the yield curve, impacting financial instruments. Impact on valuation. Fluctuations in the yield curve can significantly affect the valuation of both assets and liabilities in financial markets. Measurement and management of IRRBB. Common measurement techniques. Gap analysis. Gap analysis helps in identifying mismatches between asset and liability interest rates. Crucial for IRRBB assessment. Duration analysis. Duration analysis measures the sensitivity of asset and liability values to interest rate changes, aiding risk assessment. Simulation models. Simulation models use various scenarios to predict potential impacts of interest rate fluctuations on financial stability. Stress testing and scenario analysis. Importance of stress testing. Stress testing helps banks evaluate the potential impact of extreme market conditions on their financial stability. Scenario analysis techniques. Scenario analysis provides insights by simulating various adverse conditions and assessing their effects on bank performance. Understanding vulnerabilities. These assessments are crucial for identifying vulnerabilities and ensuring the resilience of financial institutions against market changes. Risk mitigation strategies, interest rate swaps. Interest rate swaps are agreements between parties to exchange interest rate cash flows, helping manage interest rate risks. Options as hedging tools. Options provide banks with the flexibility to hedge against adverse movements in interest rates, offering potential cost savings. Asset and liability diversification. Diversifying assets and liabilities is crucial for banks to spread risk and minimize the impact of interest rate fluctuations. Effects on bank profitability. Impact of interest rates. Interest rate changes directly influence the income earned from loans and the cost of deposits, affecting overall profitability. Strategic planning, understanding the effects of interest rates changes is crucial for banks to plan their strategies and financial decisions effectively. Capital adequacy considerations. Importance of capital adequacy. Maintaining adequate capital is vital for banks to absorb potential losses and ensure long term stability. Regulatory compliance. Understanding capital adequacy requirement is essential for banks to comply with regulatory standards and avoid penalties. Risk management. Capital adequacy is a key component of effective risk management strategies for financial institutions. Regulatory responses and requirements. Stricter capital requirements. Regulatory bodies impose stricter capital requirements to ensure banks can absorb losses, promoting financial stability. Liquidity requirements. Liquidity requirements are established to guarantee that banks can meet short term obligations and maintain solvency. Importance of awareness. Understanding regulations is crucial for effective risk management and ensuring compliance within the banking sector. Conclusion. Importance of IRRBB management. Understanding and managing interest rate risk in the banking book is crucial for financial stability. Evolving landscape. The financial landscape is continuously evolving, requiring institutions to stay informed about current risks and trends. Regulatory awareness. Staying updated on regulatory requirements related to IRRBB is essential for compliance and effective risk management. Thank you.